Hello and welcome back to this month's Insight series. For today, I grabbed one of our senior portfolio managers, Keith Gangl. Keith, thank you for joining me.
Oh, thanks for having me.
Very interesting times at the moment.
Very interesting.
Yep, and we thought
a lot of stuff to talk about.
A lot of stuff, a lot of headlines, and we thought we'd just get it all together and talk about it all today.
Should be an exciting episode.
Exactly. I will start us off as traditional with our year-to-date asset class returns, just to get an overview of how markets are actually doing year-to-date. And when we look at the last column here, well, I can see a lot more green on there than what we saw lately. So markets were recovering a little bit, right?
Sure.
And US small cap stocks are, right around even here. But US small cap stocks, international developed and emerging markets are extending their lead from earlier in the year. Gold is still having golden times, still chugging along.
Up 10%. That's a
exactly, yeah. After last year, it's still up big. So that is looking all great. But we also have some topics to talk about today.
Yeah, there's a lot of things going on.
Exactly. A lot of headlines. We hear a lot about market volatility lately, especially since the Iran conflict broke out. The market had some good ups and downs since then.
A lot of movement.
Exactly. Then inflation. Right, we heard a lot about oil prices. We all feel it at the pump lately, how that would flow into inflation, what that would mean for the Federal Reserve in setting our interest rates going forward. Also overall policy, geopolitical uncertainties at the moment, and overall also investor sentiment. And we just got a report on that today and what it all means for the market, how investors are dealing with all of this uncertainty at the moment.
There's a lot of stuff going on. So hopefully we can shed a little light on what we think is going to happen and kind of give people a little bit of comfort at least and kind of see what the next steps are for our investing, and kind of there's always stuff going on. So we'll cover a few of the things right now.
Exactly. And let's start us off with the ups and downs that we talked about. What we say volatility, what we saw a lot this year in the market. And when we look at the chart here, and you brought an interesting chart that shows actually the volatility spike. Since the Middle East conflict broke out, but there are some more spikes on this chart here. So that was not the only one. So can you talk a little bit about what that means? What informations do we get from that?
Yeah, there's when people are talking market volatility, they're referring generally, there's a index out there called the VIX, and people also refer that to as the fear index. Right, when things start spiking in this index, that means generally everybody's investors' fears are increasing. You look at this chart here, you can see Middle East conflict. What do you expect with market volatility increasing? People are getting a little uneasy. That fear factor is increasing. And some other ones, tariffs last year. Remember April 2nd last year?
Exactly, Liberation Day.
Liberation Day, yeah. But
we just had the 1 year anniversary of that.
Anniversary. It's crazy to think. I think the markets I just looked the other day were up on a 1 year basis, almost like 30-some%.
Yeah, exactly.
Now, if you would have told people that you have tariffs and Iran war, and oh, by the way, the markets last year up 30-some%. I think they'd be pretty surprised. And that's why we always talk about when you're working with your advisors and clients, and how when we talk to those groups is stay the course, stick to your plan. There's a lot of volatility, like you see in this chart here. So that the volatility is just kind of when people are fearful, but it's generally things work themselves out. And right now, times are no different than in the past.
Exactly. And you mentioned it already. We had Liberation Day last year with an even higher spike in uncertainty and fear among investors. So the question comes up, okay, what is actually happening in times when the fear rises and uncertainty rises? And you brought a very interesting chart of how at different fear levels, basically, of what happens a couple of years after that. And actually, the higher the fear is at moments, the better the forward returns are, which sounds a little bit counterintuitive at times.
It's amazing because that level of fear creates anxiety. So what do people, when they're fearful, what do they generally do? They sell stuff off. And a lot of times there's no necessarily fundamental reason. That's usually whatever is happening that's creating that fear is a short-term event. And then people go back, take a step back, take a deep breath, say, oh, fundamentals are still fine. The companies are still moving forward. U.S. economy is relatively healthy. Unemployment's still fine. Inflation's under control. You take a deep breath, and then you look at these numbers here. Over time, like you said, the bigger the sell-off, the fear factor, generally that's actually a better buying opportunity because then you have a lower point to be investing in. And when you go forward, stocks generally tend to ground higher. So as much as we don't like them, corrections are normal. Fear is part of being invested, and you're not invested in a CD where it's just flat, right? You have market volatility, but by taking a little extra risk, there's generally extra reward, and this chart shows that.
Yeah, sounds like volatility is the price of admission in investing in a market long term, and panic can create really opportunity going forward. Yeah. What comes with higher volatility in the markets, and we also take a look at, okay, what do we actually have to pay for all of these businesses that we buy stocks of, and we take a look at forward PE ratios to determine, okay, how expensive or cheap the market is, and there was also quite a shift over the last couple of weeks.
It is, and with this chart, we always like to use kind of history as a guide. That's why we always put up these charts to kind of, when we're talking, kind of hopefully put a picture to our words and kind of explain where we're at. One of the ways we value the market is a thing called a PE ratio, price to earnings, right? So as the price moves up with the S&P 500, if earnings don't move, that means your PE ratio is going to get higher. So this chart here, the normal range in the 5-year and the 10-year, those dotted green and blue lines are about 19 times PE. That's your price divided by your earnings, and 20 times. For a while there, last year, remember when people said markets were highly valued? They were, because the PE multiples are at 22, 23 times. So that's not a cheap market. And so now recently, with the market selling off, earnings are still growing. We've now are about a little bit below a 20 times PE multiple, which again is in range for the last 5 years. So while it's not super cheap, no longer expensive, I would say it's kind of fairly valued.
And it's creating opportunity for us.
And that's where you said that sell-off, generally speaking. If earnings don't decay, then it's actually a buying opportunity.
Exactly. And also a chart that we often show, because volatility and ups and downs, they never feel good, right? Never feel comfortable. But we always like to show our corrections chart to just get a high-level overview. And I think I always say that's the most important chart to remember when volatility is high, when fear is high, and when uncertainty is creeping in, because it basically shows since the 80s how the S&P returned in the red lines, and in the same column in gray, the maximum correction the market faced in this year. Yeah. And it also shows, well, even if the market performs well, there's a correction every single year. So this doesn't mean we have to be afraid of that, but we can and should be prepared for these times.
Yeah, and that's why market corrections are normal. You see this chart going back to the 80s, there's always these gray bars. And, the couple I like to point out is right now, I think that we had a correction of almost, not a full correction of 10%. I think we're down 9%, so the markets are down 4%. But as of, first few weeks of April, we're actually back to flat. And if I would have told you with all the news headlines with the price of oil, the conflict, tariffs, Supreme Court, all these other things, that the markets, the S&P was flat, people feel like if you're listening to headline news, it's a lot worse. So these corrections are normal, and I think we're still positioned for a relatively positive year. Again, do we like corrections? No, I wish the market would go up 1% every day, or excuse me, every day would be really nice, but once a month, if we had a 12% year, that would be fantastic. It would make our jobs a lot easier. Yeah, Maybe we wouldn't even have to be doing these segments if we knew the markets are going up 1% every day, but that's not the case. And if you look at this chart in 2020, you saw the COVID, the 5 weeks we were down 35%. The market finished up 16%.
Exactly, despite everything.
Despite all that was going on.
And you just mentioned it, and that was a great segue to our next concern out there, our next big topic, which is high oil prices at the moment. I think we all feel it at the gas pump. It's more expensive. And so let's talk a little bit about oil price spikes. And you brought 2 interesting charts, one over the last 5 years and one specifically over the last 3 months, where we saw the Iran crisis completely playing out. But especially over the last 5 years, it's the second largest spike, or the largest spike since 2022, when Russia invaded Ukraine, and when we had also some oil shortages and discussions.
High inflation. Right?
Exactly. So can you talk a little bit about what that all means and why we are so jittery about oil, especially at the moment?
Yeah, oil, you feel it, just like, remember back in 2022, we had high inflation. Was not only just food prices, everybody remembers food and shortages, but price of oil, price of gas was over $5 at the pump. So that's inflationary, right? No one likes that. Inflation's a tax. High oil prices are like a tax. The lower the price of oil, the better off. At some point in time, it becomes a headwind where prices are now. So that's why it's something we have to pay a lot of attention to here. And that's the reason that investors got nervous about this Iran conflict, because of 20% of the world's oil flows right around Iran, and if that's disrupted, oil's a global supply, then that could cause a higher price, which we've seen here at the pump as well. We've seen oil going, our price of barrel here is, and price of at the gas pumps follow that as well. So recently we're above $99 a barrel. We spiked up to 110, 115. Prior to the conflict, we were at 65.
Exactly.
And you can see in the pump, it went from roughly the national average went from around $3.50 to $4.50. So it's $1 increase on $3. That's a 30-some% increase. And not only just in your transportation costs, but these tables, your watch, all these resins, the clothes even that has petroleum products in it. So those are why we're concerned about high oil prices.
Exactly. And you just mentioned it. It's not oil in and itself, not only gas, higher oil prices. I mean, it feeds in a lot of products, right? Sure. It's also jet fuel, diesel, fertilizers. So that's, if it's not an input cost for the product in and itself, it's usually somewhere in the value chain and in the supply chain. And that also, matters for the economy because it's what we use all day, every day.
Yeah, you have a great chart here talking about jet fuel. It's up 95%. Think about that. So when you book your flights, it's, if those airlines that you're on, that was kind of, they can't raise the prices on you. They can maybe cancel a flight on you, but now when we're looking at booking out prices of airlines going forward, I would expect the ticket prices are going to go up, which that impacts the economy. So if you travel a lot for work, then maybe you'll travel a little less, which then kind of potentially slows down the economy. So it has all kinds of these ramifications down the road with high oil prices. And again, the jet fuel one here is just kind of astonishing. That it's almost double the price for their input costs.
Absolutely, because at the end of the day, for the consumer, it leaves less discretionary money for something else.
For sure.
Exactly. And maybe also take a look at what higher oil prices and generally higher product prices because of that mean for overall inflation. And we just got the first inflation report today since the Iran crisis conflict broke out. So the first real inflation report where we see some influences for that.
Again today?
It was pretty high. We have a pretty difference between headline inflation and core inflation, and that's what I wanted to talk to you about. Why is that such a difference between headline and core, and what does that all mean now?
Yeah, which I always kind of comical that there's core, which then they exclude food and gas. And we just talked about how important food and gas is. It's crazy that that there's government stats that say, don't worry about inflation. We X out your food and gas, which is what most people see every day. It's like, that's just kind of a lot of volatility. Yeah, it's not good when the volatility is on the upside and you have higher oil prices and higher food prices. So that's something that, stats we have to be aware of, and the government likes to exclude it because of the way it moves around so much. But in actuality, we like to look at both numbers because it's like, okay, where's the actual core? So if that's not moving as much, but you certainly have to consider oil and food prices, I believe, in when you're making kind of investment decisions, because that is directly impacting a consumer. And if they don't feel as confident about their wallet, they won't spend as much, which then slows down the economy, which is not a headwind for the stock market.
Yeah. And when we talk about inflation, what does that also have to do with the Federal Reserve in setting our interest rates? I mean, I remember when we come into the year of 2026, the consensus expectations were pretty good, like 2 to 3 interest rate cuts maybe, that the stock market loves it. It's good for the overall market rotation that we saw happening in the beginning of the year. And all of a sudden, we have a different picture.
Yeah. So generally, the markets like rate cuts, right? Because that makes money cheaper. So the U.S. GDP is driven by about 75% is driven by consumer spend. It makes spending a lot easier, right? If you can go out and get a car loan, your credit cards are less, then you're willing to spend more. And that's what, it's kind of tied to the Fed funds rate. If they're cutting, those rates should generally come down, which should allow the economy to kind of speed up. Now, the Fed's got two dual mandates. If you hear dual mandate, they're referring to stable prices, which is measured by inflation, what we just talked about, and full employment. So right now, employment's fairly steady at around that 4.5% unemployment, which is fairly steady. But what happens if oil prices stay as high as they are, that inflation argument's going to tick back up again. And then those cuts everybody wanted, they're going to be off the table. And there's some people even talking about potentially raising.
Exactly. There was already some whispers about that. Case,
but I've been more of the camp of 0 to 1 cuts for the year. But you're starting to hear some chatter on that.
And also when we talk about all of what's going on currently, keeps investors sure on their toes, then we also have to take a look at how are investors actually feeling at the moment. And sometimes that differs a little bit from what they're doing versus how they are feeling. But we just received a new statistic on that today, which is the Michigan Consumer Sentiment Index. And that's the worst reading in their over 70-year history of how people are actually feeling about what's going on is the lowest in 70 years. But an interesting caveat here in the doomsday, so to speak, when we look at the chart that you brought here, then it seems like, especially when consumer sentiment is low and near its trough, then that means we actually can see a turning point soon.
It's usually a buying opportunity, just like when the fear factor VIX goes up, markets sell off. That's usually a sign that the investors that have patience can actually step in, and when they start looking out, at 6, 12 months, markets generally tend to be higher. And that's the same thing with sentiment. And this year, I would say, if I did a poll of all of our different clients and just people we talked to on the street and said, hey, where do you think the S&P 500 is, the market? Most people would say down. It's got to be down 10, 20%. In actuality, it's flat as of the other day, which means it hasn't done a lot. It's gone up, gone down, back up. Markets do that. And sentiment sure is negative. If whether you read a newspaper, if anybody even does that anymore, turn on your TV, whatever social media you're on, you're certainly seeing something about the Iran conflict. And that just makes people uneasy, right? Unknowns, uncertainty make people uneasy. And then there's constantly should be there, shouldn't be there, what's going on, complete unknowns. It makes people feel uneasy. It doesn't surprise me that the sentiment's so bad. That's usually when it starts kind of troughing, that's probably a buying opportunity.
And also to wrap it up with the topics that keep us on our toes. And there's obviously a lot more to talk about and a lot more that keeps investors busy. But these are the main ones. And we also talked about it, high oil prices. And why that is the conflict in the Middle East at the moment that is still not resolved. So we hear a lot about that every day of changing expectations. And you brought an interesting chart here on the left side, how it's impacting global equities, oil prices, and the U.S. dollar value a couple of weeks before and into the war. And interesting is also the U.S. dollar value actually gained some strength again. And why is that when we see conflicts breaking out that the U.S. dollar is usually getting a little tailwind from that?
Yeah, that has some people scratch their head. You would think with the U.S. and this conflict that would be negative for the U.S. dollar, but more uncertainty, generally speaking, is causes the dollar, I believe, is still king dollar. So more uncertainty. I think people, as much as you may think that the U.S. has kind of got some financial leverage and too much debt and this and that, the companies that operate within the U.S., they're doing fantastic. I think they're still doing very well. And I think that's why people come back to the U.S. dollar. I think is still king of dollar. Now, it's certainly there's some issues, right? It's not perfect. But then you look at other countries, you start comparing apples to apples. It's just like, guess the U.S. isn't so bad. And I think that's where you get kind of a little bit of a flight to safety.
Yeah, exactly. And also on the right side, I mean, it's a little bit looks like you threw spaghetti on a wall here, but very easy way to look at it. All the gray lines are different wars and different conflicts within the last decade. And the blue line here, which is the important one, is the average out of all of them in the couple of months leading up to the conflict and after. And it sounds a little bit counterintuitive, maybe, that a couple of weeks into conflicts, before the conflict is actually resolved, markets tend to look beyond that and focus back on the economy and what's really driving markets, which is the economy and the strength of U.S. businesses.
Yeah, the first few weeks, normally that conflict starts, it's like, oh my goodness, it's going to be the worst. And people do start selling out, generally speaking, is what the chart shows. But then if you're impatient, that's usually a buying opportunity because, again, what investors do ultimately is they go back, look at company fundamentals. Have they changed? The Russia-Ukraine situation is a prime example when, no one knows what was going on there. Markets sold off a little bit. And look what ended up happening. The European markets had a fantastic year just last year. I mean, they were up, 28, 30, 32%, some of these different, geographies, which is shocking when you think that they have higher oil prices. They got this Russia-Ukraine situation. Some of the other European countries kind of getting dragged into it a little bit. So it's markets kind of look through those events, not, putting these conflicts at light, but investors, generally speaking, use those as buying opportunities. And I assume this Iran-Contra conflict will kind of Again, we don't know. We don't know what's going to end up happening. And if price of oil stays higher, then we'll have to be less positive. But if price of oil kind of comes down, that was the one chart we showed you earlier. If that comes down, I think the markets will look at company fundamentals. And I think the fundamentals are very, very strong right now, that the markets can do what they historically done, is kind of end up moving to their average performance over the next year, which is about that 8, 10, 12%.
Exactly. Keith, thank you so much for breaking that all down with me today. And there's a lot going on, and we just discussed a couple of very important headlines and what's going on in the markets today. So thank you for joining me.
Thanks for having me.
I will summarize what we just heard. Increased volatility can create opportunities, and while it doesn't feel good, it can help us in our investments going forward. Geopolitical conflicts increase short-term volatility, but normalize in the long term. And higher for longer oil prices can put upward pressure to inflation, what we saw with the latest report. Moments of weak consumer confidence can also often mark a turning point. And it also reinforces the value of diversification and rebalancing your portfolio. And as always, have a long-term plan in place, stay diversified, but stay invested, most importantly. And with that, thank you so much for joining us today, and thank you for your precious time. We will be back next month with another exciting topic of what drives the markets.